Hello and welcome to McQuilling TV. I'm Allison O'Melio, and joining me for the first time today is Connor Stone, Marine Transport Advisor at McQuilling Services. Welcome, Connor.
Thanks for having me, Allison.
We brought you in today to talk to you a little bit about McQuilling Services' short-term views for the tanker markets. I know the group recently published its March short-term outlook, and within the report there was a discussion about the new U.S. administration and its plans to revitalize the domestic energy sector. So should that happen, what potential impacts could tankers in the U.S. Gulf be faced with?
Well, with the promised rollback of environmental regulations and increased spending on oil infrastructure, we can definitely expect the U.S. oil and gas industry to expand further in the coming years. In the short term, U.S. production is expected to increase. It's already reached over 9.1 million barrels per day. And we also noticed that the Canadian output is increasing, which will likely be pushed into the U.S. refining system, which frees up U.S. crude for export. Now, if you have more U.S. crude for export, you've got more cargo opportunities for dirty tankers trading in the Gulf. So with that expectation, we would see higher demand in the short term for tankers trading in the Gulf. And what we've also noticed is that cargoes are making their way to eastern markets, which expands the ton miles and increases demand.
Where else are you seeing increased demand in the next couple of months?
Well, we're very bullish on the Black Sea market. We've already seen an increased amount of Suezmax loadings compared to last year in that market. This is largely due to increased production from Kazakhstan, and this is because the Kashagan oil field restarted at the end of last year, and it's projected to increase output to 370,000 barrels per day before the end of the year. Now, all this extra supply in this region is putting a lot of pricing pressure on Urals-linked and Brent-linked crudes over the Dubai-based crudes.
Okay.
Now, with this shrinking differential, what you have is a lot of these Black Sea cargoes are moving to eastern markets, which is a benefit to tankers trading in this region because it boosts ton-mile demand. So we're very bullish on the Suezmax Black Sea market.
So speaking of the East, there's a lot of talk about increased refining capacity in the region. So what does that mean for clean tankers?
Well, generally when people hear increased refinery capacity, they think it's a good thing for clean tankers. But the issue with this is all the expansion is happening at the largest refined product demand centers in the East. So you have LR vessels trading in a shorter mileage, which decreases the ton miles and is not good for demand. Where we do see some upside is the gas oil flows out of the East towards Northern Europe because European refinery utilization is expected to decline this year. But the biggest headwind for the entire LR sector is going to be the massive delivery schedule we're expecting this year. We forecast about a net fleet growth of about 56 LR vessels. Now, this is going to put some serious pressure on rates. And what you also must take a look at is the delivery schedule of the dirty tankers, because VLCCs and Suezmaxes will sometimes take clean cargoes on their maiden voyages, which pulls a lot of demand from the LR sector. So we're not very optimistic about the LR sector this year. We're actually forecasting TCEs to be lower than $14,000 a day.
So not a good year for the LR owners.
No, not a good year.
Well, thank you so much for the insight, and we really look forward to talking to you after the next short-term outlook is published, which is when, early April?
Yes, early April, and I look forward to coming back on.
Great. And that wraps up this episode of McQuilling TV. I'm Allison O'Melio. Thanks for watching.